as the massive ETFs now come into the crosshairs, as these all have unallocated on and off flywheel. Yes, and once again, the smaller and less obscure silver market provides us the better window into what the same actors are doing in the ring-fenced, much larger gold ETF, GLD, that big monolith. I recall discussing this subject back in February, and where we focused on we all remember the implausible thousands of tons of additions that were added following the EFP blow up back in March and April, where there was no physical around, and suddenly everyone wanted it. Where was the only place to go? You couldn't buy it on the physical market, so you went to the ETFs. Oh my goodness, they seem to be able to be loading hundreds and thousands of tons in when we knew there wasn't any. So obviously that created an issue, and that's when BlackRock issued a warning, and that was in February 2021, I remember, as the silver short squeeze drove silver into the 30. Bearing in mind, these guys have bet against that. And what was absolutely clear to every silver wholesaler and bank was that this was a warning. This was a warning to bail out the SLV's authorized participants. These are the APs who work with the trust to create new share baskets of the ETFs. And I remember the wording was pretty clear. We may be unable to acquire enough of the metal, and that SLV may suspend or restrict the issuance of baskets of shares. I mean, give your head a shake. I mean, this announcement followed an emergency meeting with these authorized participants unable to supply. And at the time, there was a 1 week window where 1.5 billion in physical silver inflows were recorded into the trust. And this is when the warning came in, because it clearly wasn't coming in. And going to market, really, this is the point that should be made. Going to market to obtain this amount of silver would have driven silver to somewhere between 50 and 80 bucks overnight. But worse, for the market making insiders betting against silver, such a bid-only move would have triggered in fresh demand in sufficient size to bankrupt the too big to fail authorized participants. And of course, this embarrassing BlackRock admission to not supply silver cuts the same way. This is a point I'm trying to make for the much harder to read gold ETF. And I specifically talk about GLD in this case, as some Swiss ETFs are actually physically backed, and as are Sprott, etc. But I mean, I'm specifically focusing on GLD and how it interconnects with the COMEX. But what it exposed was that these so-called investment hedging ETF vehicles do not represent or discover a real supply-demand price. Otherwise, you'd be forced to go and fill those vaults. Now, what it exposed was that the on and off ramps are not physical. And as soon as the rubber met the road and the physical demand meant the unallocated gold and silver position representing these gold and silver baskets had to be turned into real physical bars for delivery, and the APs, the LBMA gatekeepers, refused to go to market to buy the physical, which would have seen a substantially higher real supply-demand gold and silver price emerge. That's supposed to be what markets are supposed to do. And we also know that while the gold and silver bars are signed off as existing, that they're also allowed to be bet against, openly short-sold, and essentially, what is that? Rehypothecated. But here's where it gets really interesting, and I don't think anyone's focusing on this. The unallocated flywheel that has allowed the related gold ETFs to be managed by the authorized participants using these holdings to bet against GLD prices from rising above their managed COMEX pricing envelope is going to have to be backed by physical. This is a huge deal. This will be a game changer, and it'll allow the funds who must use ETFs, these hedge funds that come in and out all the time, but usually get flipped out again because, by the way, you can play with that game. But if it was physically backed and they were really gaining exposure to gold and silver, and then you would see a real uncapped return. They would get a real uncapped return on these investments as those prices rose as these funds came in to buy and were not rinsed back out again. Now, once let loose from being suppressed by the freshly compliant authorized participants managing these baskets, it's going to make these instruments very attractive to those captive funds who are unable to gain exposure to physical bullion. And there are many funds, it's not in their mandate to be able to buy physical. So it's important. This is a huge deal.
Andrew, as we come to the end of the year, what can our Live from the Vault viewers, what can they expect for gold and silver moving forward?
Shane, good question. Very short term, with the BIS, again, successfully containing the gold price to square off these excess unallocated contracts. By the time we publish this interview on Friday, we will be getting the next CPI print. And unless you're a stacker, I'm suggesting really kind of wait till the dust settles. Then we expect a sizable rally to develop into the year end, and structurally, even with the dilutive over-the-counter paper hedges in play. 1900 is fair value, but seasoned traders really ought to expect some volatility, as the BIS will still likely want to have a last kick at the can. So we may see gold being contained until the last possible minute. That's not really what we expected, but it's what's happening. But given the deeply technically and fundamentally oversold condition, I see little to suggest that we should close below an optimum 1805 to 1830 window. I know that's a big window, but essentially above 1800. And that's not where we are at this moment when we're playing, where we're seeing this gaming going on in a very thin market today ahead of CPI. Now, the sweet spot, people say, what is the sweet spot? It's the balance level where the BIS derivatives can be squared as cheaply as possible, while at the same time exposing the BIS unallocated positions to as few sovereign competing bidders as possible. And after such heavy containment, gold and related silver are coiled, and January will be explosive. Now, structurally, following the November BIS OPEX defense, all the spec longs that were added above 1800 gold futures, they've all now been flushed out by the House. And further spec sells into a very strong physical market will be naked short, with insiders exposed to backwardated delivery obligations, those that cannot be offset, that is, with a spec short. They'll be taking the long side. And you're going to see it one more time. They always win. The House always win. Only because of the paper dilution, which is going to start to evaporate. So safe haven demand is now accelerating, and what it's going to do is underpin paper market sells along the way, even before we get to the end of the year. Now, stackers right now are having a whale of a time into unallocated position squaring discounts, but for traders, perhaps look for a buy stop in at around 1800, and this would unleash a very large coiled physically driven rally, the regaining of 1800. And so, I mean, if you look at the daily charts, my God, the daily charts are so deeply technically oversold, and silver in particular, but both. Silver is actually more deeply oversold, technically oversold, than it was in March 2020. The pricing action you're seeing today is really it's a farce, and we can explain that a little more.
Andrew, to wrap up here, so where does this leave us as we approach the end of the year, and especially with silver?
Shane, absolutely. We know silver is your baby. Look, as I say, I think I've just mentioned, silver's not has never been this technically. In fact, at no point in history can I remember silver being this technically and fundamentally oversold. And even more so than just before it spiked an $18 rally from $12 to $30 in March to August of 2020. And the very short-term action we're witnessing is directly attributable to the condition we described in gold, which is namely adding COMEX shorts, hedged by leverage over-the-counter longs. And we've got direct evidence. Now, silver gives us a beautiful view into this thing. We have direct evidence of this, as we evidenced Standard Chartered Bank, COMEX market maker, LBMA market maker. They were aggressively locking in forward physical purchases with our same suppliers, same places that we buy. We were getting phone calls saying, we're now sold out. Premiums, sorry, but we just gave your excess, as you say, you usually start the year by saying, here's the minimum, here's the maximum. And as long as you take the minimum, you can usually get the maximum. That's all been removed. The Standard Chartered were actually, and this is the important point, on December the 1st, at the exact same time period, and I'm talking from minute to minute, we saw a cascade. Look at any chart and look at December the 1st, and you'll see at the commencement of a cascade of sell orders from $23 to $22. These were short positions coming into the COMEX. Now, the irony is, this is the exact time that Standard Chartered was buying physical and forwards right into 2022. That's just one example, because this proves and shows how this game works. And look, they're not alone in using this tactic. So basically, they always know that anything they short sell will never be actually physically delivered. But what they were doing is literally using that, throwing in those shorts, hiding the over-the-counter longs, completely unreported, but using that as a way to say, well, we're not exceeding position limits. But even more so, what they're doing there is enabling, putting in the sell orders in the COMEX, driving the price down, locking in a physical price, a spot price for silver, and happy to pay a big premium for it, using that conduit, using that game. And that is the game that has to stop. It's going to stop in gold. And when it stops in gold, you can't drive the ratio trade to hundreds to one. It will end up affecting silver. So as I say, really, we're really at a point here where we should be thinking about not just stacking, but getting ourselves very, very long. Wealth preservation is number one. So that's the first thing to consider before even thinking about making money. Wealth preservation, silver and gold is going to protect you, and we can see an enormous rally coming anyway, regardless of that, into the new year.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much, much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.